Okay, so now let's jump into our financial planning topic. Okay, so you should see my whiteboard in front of you, and it should read financial planning topic, Roth conversion, break-even point. So raise your hand if that's what you're seeing, please. All right, great. So this is a common conversation, right? People say, okay, I get it. I get the tax value of Roth conversion, but what's my break-even point? So if I convert $100,000 and pay $20,000 in tax, when do I make up that $20,000? So the answer might surprise you, but let's first talk about some fundamentals here. So remember our buckets. We've got your taxable bucket. So this is anything that every year generates a 1099 that's not a 1099-R. So for interest, dividends, short-term gains, long-term gains, you get K1s as well. So, and all of those things equal tax, right? You got to pay tax on that every year. You got to pay tax on the interest from CDs. You got to pay tax on interest from municipal, mutual money market funds, long-term gains, short-term gains in investments or mutual funds or ETFs or individual stocks, individual bonds. You pay tax on all those things. So with individual stocks and individual bonds, yes, you can control when you buy and sell them, but still, with most people still invest in mutual funds, and with mutual funds, you have no control over that. So there's a big issue with Vanguard last year with one of their target date funds. People were investing in a target date retirement fund in this taxable bucket, and it ended up with these large capital gains that they weren't aware of or expecting. So that's the taxable bucket. And then you have the tax deferred bucket. And the tax deferred bucket is your IRAs, traditional 401ks, anything you promise to pay the tax later, right? You're not paying tax now. Maybe you get a tax deduction going into it, or you don't pay the tax now, but you have to promise to pay it later. So the issue, of course, is what's later going to mean? And we have the I don't know. That should be a question mark. Let me see if I can fix it. And apparently Bill Gates heard me complaining about this new whiteboard because he fixed the fact that I could roll this over now and erase with it like I could before. But the promise, the issue is with this promise to pay later is we don't know what the taxes are going to be in the future. So many of us prescribe to the idea that we have a certain amount of money we want to keep in this bucket. We potentially have a certain amount of money we want to keep in this bucket, and then everything else we want to push over to the tax advantaged or tax-free bucket. Now, there's only two things that are truly tax-free under the tax code, and that's anything Roth. So Roth IRA, Roth conversion. Roth conversion isn't a type of account. It's a process, but that's okay. Roth 401k. And there are some rules. There's a 5-year rule, things like that for when those funds are tax-free. But fundamentally, when you move money from this tax-deferred bucket or this taxable bucket, or you make contributions or conversions, they're the only way that you can get money into a Roth, either contributions or conversions. Then anything over here, you never pay tax again. So Ed Slott likes to say you want to move things from forever taxed to never taxed. Really, it's from forever taxed to never taxed again, because once the money gets over here, anything that comes out is 0% tax, assuming you meet the 5-year rule, which is really easy to do if you're over 59.5. The only other thing that's truly tax-free is some forms of cash value life insurance, or as my friend David McKnight likes to call them, life insurance retirement plans. So the idea, of course, is to identify what needs to go here, and then everything else shift over to Roth or the life insurance to have the tax benefit. But we're going to focus right now on the Roth side. So here's where and we're going to talk about conversions. So they're the fundamentals, right? We identify the buckets, we identify the amounts of money we want to have in each bucket, and then we want to get, the right amount here, the right amount here, and then everything else over to this bucket, whether it's the Roth or cash value life insurance. But focusing on Roth conversions, this is where I get the question. Well, Mark, what is the break even on this? Well, the break even doesn't really exist. I'm going to tell you why. Because here, let's just focus on our two tax deferred and tax advantage buckets. So here's our tax deferred, and here's our tax advantaged or tax free. And let's do some real simple math. So what people are talking about when they talk about the break even is they say, well, wait a minute, if I have $100,000 in the account here, and you're saying I should convert it over here and move it to my Roth for this example, or, in any case, the toll, let's just say, or the cost of going from tax deferred to tax free is, of course, tax. You have to pay the tax on the way over. The Roth conversion is really a distribution from your IRA that the IRS allows, and then a redeposit into the Roth. So it circumvents all the rules about income and all those, the age, all that stuff. They just allow you to do it. So now let's assume, and it's always better to pay the tax out of the taxable bucket if you can, right? But let's assume, just to keep the math, the discussion clear, that you're going to pay the tax via withholding out of the conversion. So we have a 20% tax rate for this example. It's always different. It depends on your situation. This is just an example. Sometimes it's more, sometimes it's less. But let's say we have a 20% tax rate. So of course, this $100,000, we end up with $80,000 in the Roth, because via withholding, we send $20,000 directly to the IRS, never to be seen again, spent as efficiently as the government spends money, right? So that is withholding. That's not unlike what happens in your paycheck when you're working for, anyone. You withhold part of your earnings, and that goes to the IRS every pay period, week, twice a month, whatever your pay cycle is, and you get what's left, right? You get your pay stub, and they would have all those withholding amounts. It's the same when you do a withholding on a Roth conversion. You send that amount to the IRS, and then you reconcile it when you do your taxes, just like you doing your taxes are really a reconciliation, isn't it? You either owe more or you get money back. So in this case, we send the money to the IRS. Now there's only $80,000 in the Roth instead of $100,000 in the tax deferred. And this is where people say, well, how long does it take me to make that money up, right? How to break even that $20,000? Well, the answer is it's immediate. The only factor is if taxes are going to be more or less for you in the future. Is your tax rate going to be higher or lower? Because if your tax rate stays the same at 20%, then it's always, these two are always going to run the same, assuming they're invested the same. And you get whatever you can invest in your tax deferred bucket in an IRA, you can invest in a Roth IRA. Now you may invest differently in your Roth. You might be more aggressive, you might be less aggressive, and that would change. But if we're comparing the same rate of return, which you should when you're comparing this, then it really, there is no breaking point. I mean, that is the answer right there. And why is that? Let me show you the math. So let's assume this doubles. So everybody knows, well, you probably know the rule of 72. So let's just say over 10 years, if you average 7.2%, this $100,000 will double. So you've grown this $100,000 to $200,000. Now, assuming that your tax rate is the same, right? It's 10 years later, assuming your tax rate is the same, and you want to take out that $200,000. Well, how much are you going to have to pay in tax? Well, $200,000 times 0.2, right, for 20%, that is $40,000, right? That's $40,000. So $200,000 less $40,000 is $160,000. So after tax, what you'd be able to spend out of that $200,000 is $160,000, assuming your tax rate is the same. Now let's look at the $80,000 that you transferred over here to your Roth. So you've paid your tax. You never had to pay tax again. 10 years goes by, you earn the same amount of return. You average 7.2% over 10 years. Well, you double this and you have $160,000. That's the same, isn't it? $160,000 is the same as $160,000. So the break-even point is immediate, assuming taxes are the same, assuming the investments are the same. So you have control over the investment returns, you really do, by your choices. You don't have any control over the taxes. So really it comes down to, are taxes going to be higher or lower? So that's where the fundamental issue is. Are taxes going to be higher or lower? Because we believe that the average middle-class American is going to be in the 40 to 45% effective tax rate. And we study this on a regular basis. And, we've got good information to back that up. But there are still people who say, well, you're going to be in a lower tax bracket in the future. Well, I don't know anybody that we work with, or I really don't know anybody at all who's going to be in a lower tax bracket in the future because of all the pressures that we have. But we do know there are certain things that are coming that are going to affect this. And if taxes do increase, let's just say taxes only go up, and now you're a little bit, and your tax rate on that $200,000 is 25%. So then if your tax rate only goes up 5%, well, Mark, I don't necessarily agree, or I can't understand that my tax rate would go as high as 40 to 45%. So, okay, let's say it only goes up to 25%. So no longer are you paying 20% tax, you're paying 25% tax. Well, your $160,000 then, of course, becomes $150,000. That's not yours anymore. This is yours. Remember, you have a partnership in your retirement with the IRS. The IRS determines, well, Congress determines how much of that partnership or how much of your retirement accounts you actually own. So if you're fortunate to have $1 million in your retirement account, how much of it is really yours? It might be today $800,000. In a very short period of time, it might be $750,000. In this case, $200,000 goes down to $150,000 in spendable money. What's changed in the Roth? Nothing. You still have $160,000. Let's say your taxes go up to 30%. Well, now this $150,000 isn't yours. Taxes are now 30%. Now you have $140,000. Taxes have gone up, now 10% for you. What's happened to the money that you converted to the Roth? Hasn't changed, stayed the same. So now let's just say that we hit our 40 to 45, and I actually did 42.5, but let's just assume 40 to 45 effective rate. Now that brings you down to $115,000. So you got to pick one, folks. So who do you trust? Do you trust your own ability? Do you trust the people you work with? Where's my green? Because this 160 here, oh, that's fancy. That's going to stay constant. We're certain, and I think you are too, that taxes are going to increase. So your $200,000, the only way that there is this break-even question is if you have to assume that you never pay tax coming out of the IRA. Now, there is a way to do that but it's dependent on your situation. But for most people, well, for many people, you're always going to pay tax on the money coming out of your IRA. So the answer to the question, when is the break-even point? It's immediate, dependent on the future of taxes. Now, you might say, well, Mark, I don't know, do taxes really have to go up? Let's explore this. So stay with me. I know we're past the 10:45, but stay with me. So I showed you the math. We talked about the fundamentals. So the next question is, will taxes increase? So I've got some information here. So the first thing I'm going to show you here is our 2022 chart. I hope you can see that. And the 2017 tax planning chart. So why am I showing you the 2017 tax planning chart compared to the 2022? Because in 2025, 12/31/2025, this goes away and we go back to this. That is the sunsetting of the Tax Cuts and Jobs Act. We are currently operating under the Tax Cuts and Jobs Act of 2017. That sunsets 12/31/2025, and we go back to this tax table here. So someone recently said to me, the CPA for a fact, they said, I don't know, I don't think this client should do Roth conversions because they're going to be in the 12% bracket, for the rest of their lives. Well, in 2025, the 12% bracket actually doesn't exist. So these are the things you actually have to look at. Now, so this is legislated. The Congress has to do nothing for this to take place. And if they do something between now and 2025, it's probably going to make this worse. Now, so the 12% bracket that we have now, I know these are hard to see side by side, especially because these are slat tables and they've inverted. They've changed the direction of the taxes. But the 12% becomes 15. So this goes away and that becomes 15. The 22 goes away. That becomes 25. Let me see if I can draw these a little clearer for you. I don't like this color. Let me see if I can change this. I don't even know where this color came from. Let's see. The 22 becomes 25. The 24 becomes 28. The 32 becomes 33, 35, 35, and 37 becomes 39.6. So you can see the most affected ranges are in the middle here. So let me erase these because I want to show you something even more important here. And that's the amount of income. So I hope you're following on this, because not only is the biggest effect in these middle brackets, middle-class Americans, this is what I'm talking about, while middle-class America has to be in the 40 to 45% effective tax rate. The biggest changes are here, aren't they? So from the 12% up to the 32%, or really up to the 24%, we get the biggest jumps because it goes from 15 to 28. So just from a marginal tax rate, it gets much higher. But look at the income. Just one example, the top of the 24% bracket this year is $340,000. Let's look at the top of the 28% bracket on the 2017 rates. Well, it's $233,000. Adjusted for inflation, I'm thinking that's going to be about $262,000. So that is $100,000 difference, just about from where we are today. Actually, yeah, $120,000 difference from where, I'm sorry, I guess just about $80,000 difference from where we are today compared to where we're going to be, and we're going to be at 4% higher. So my point is, you're going to hit those higher marginal tax rates much, much faster. So legislation is one thing. So we've got legislation that's going to happen, folks, unless Congress intervenes between now and 2025. And if they do intervene, it's likely to be worse. Don't forget the Congressional Budget Office said our tax rates have to be really simply like this. Right? 25%, 62%, and 88%. That's what the Congressional Budget Office said. So, they're frightening numbers there. So we're well on our way just legislatively. So taxes have to go up just by legislation alone. Now, why else may taxes go up? Let's look at some other reasons here. So I'm just trying to scroll down here. See if I can get some help with my mouse. I see what's happening. I'm going to turn that off. No. Okay, I'm getting some. So Bill Gates needs to pay attention again because I can't quite scroll here. Stay with me, everybody. I think that's the one I want. Okay, there we are. All right, so this was interesting. So this is from the Peter G. Peterson Foundation, and this was put out May 31st. So interest on the national debt is a big one. We're seeing interest rates go up. We've been talking about this. Our not only is our national debt going up, but our interest is going up, and we must pay the interest on our national debt. We can't not pay our interest. And we can't not pay our debts because, then we'll have a sovereign debt crisis, and no one will want to invest in the U.S. and our monetary structure will just crumble. So this organization, the Peterson Foundation, had this really great article, and it talks about interest costs will reach historic highs within the next 10 years. The Congressional Budget Office, CBO, projects that annual interest costs will rise from $399 billion in 2022, right, to $1.2 trillion in 2032. As a percentage of gross domestic product, or GDP, those costs would double from 1.6% of GDP to 2022 to 3.3% in 2032, which would be the highest level ever recorded. Interest costs are now projected to be significantly higher than the Congressional Budget Office calculated nearly a year ago, just over a year ago. Folks, it's going to get worse and worse and worse. It's going to compound and likely to get worse. Over the 2022 to 2031 period that CBO reported on last year, the agency projected the interest costs would total $5.4 trillion. Rapid inflation and higher interest rates have boosted that projection by $1.9 trillion, or 35%. Over the current 10-year period from 2023 to 2032, interest rates would total $8.1 trillion. So that is a nonpartisan group, the Peterson Foundation. You can look them up. If you look at the board of directors, they represent really just a broad brush of different experts from different political parties. So now we've got legislation, right? Legislation says taxes have to increase. Our national debt says taxes have to increase because there's only really one place to get this revenue. There's small little other places where revenue comes in, but it's mostly from us, the taxpayers. Now we look at, you've heard me talk about the 2022 Social Security and Medicare Trustees Report. So to make it really simple, this is Social Security. The year trust fund reserves are depleted, 2034. No more money in the trust to pay Social Security by 2034. That means only a portion of the benefits are payable to folks who receive Social Security. Nobody is going to accept that. Nobody's going to accept that. This hospitalization insurance is Medicare. The year trust fund reserves are depleted for Medicare is 2028. If that's not right around the corner, I don't know what is. That's why we say you've got to do everything you can to get your tax efficient strategy done by 2030. If you have to go a few years beyond that, we can manage it, but ideally we want to get it done by 2030. So we have Social Security and Medicare, we have legislation, we have the national debt. The other thing, going back to, and some people still say, with all this evidence, some people still say, I don't know, Mark. Somebody somewhere is going to find a solution to this. I don't know what it is. I don't know what it could be, but somebody will figure it out. Well, one thing I can tell you for sure, even if you don't believe all that evidence, if you go into retirement as a married couple, let's look at what we have here today. Now, my green pen's not back. What's certain is that one of you is going to die before the other, nearly certain that one of you is going to die before the other. So look at the change in the tax rates for a married filing joint couple and a single person. Look at the difference in income, 22%, $83,551 to $178,000 drops to $41,776 to $89,000. That means that as soon as you cross over $89,000 of taxable income, you go up into that portion, right? That's over $89,000 goes up in the 24% bracket. If you want to maintain the 12% bracket during retirement, if you can, you're at $20,551 to $83,000, pretty generous for 12% under the current rules. That drops if one of you passes to $10,276 to $41,775. And once we get to 2025, of course, the numbers are much worse. We're back down here, 15%, right? Because 12% is gone. If you're married filing jointly, you got from $18,651 under the 2017, that'll adjust for inflation, to $75,900. But once you're single, you top out at the 15 at just $37,950. So even if you don't believe all the evidence, you have to assume if you're together in retirement and you're both 65, 66 years old, that you better die at the same age, or your taxes are, or you're at the same time, or your taxes are going to be much higher for one of you. So I hope that helps. Again, if you're watching this on YouTube, hit the subscribe button, hit the like button. If you know people who should join our webinars, you can tell them that they can register. What I've shown you here is that this is a myth, really, this break-even point. There is no break-even point, assuming taxes are going to be the same or higher. And I don't see evidence of why taxes would stay the same or be lower. So for most people, it makes sense to take a look at Roth conversions. I hope that was helpful. I do have a question. Let's see what the question is here. Furthermore, Walter says, the Roth may have additional advantages for Social Security taxations and IRMA. Yes, we're going to talk in the next couple of weeks about Social Security taxation, and we're going to talk about IRMA as well. Thank you, Walter. It's just too much to talk about this. I'm obviously very passionate about it, but there is no break even, assuming taxes are going to stay the same or go up even slightly, even by 1%. Still, that break even doesn't exist. And I've highlighted just a few reasons why taxes have to go up significantly, if not double, within the next 10 years. So thank you, folks. I hope you enjoyed it. If you have any questions, thank you, Kathy. If you have any questions or need time with me, please reach out, and we'll see you next week. Take care.